Now, in similar tone, switching gear, so Christian Bale, my personal favourite actor of all time, played Michael Bury in The Big Short. Margot Robbie made an appearance in that, a few other notable actors as well. Now, that was
Now we know how you spend your time.
I watch finance movies and I work in finance. It's only to realise my job's never as exciting as the movies, but there you go. So Michael Bury in The Big Short, he predicted the whole thing in effect and then managed to profit from it.
Yep.
Now, what lessons can we take out of that?
Well, I think one of the hardest things within markets are very much a herd mindset. If you talk about analyst expectations, for example, there's always consensus, which is the big mob or blob that sits in the middle, and then there's a little bit of peripheral action around that. But most people like that central tendency of being part of the mob. There's a security factor there. And when you choose to step out from that spot, there's enormous pressure because you're putting yourself out there in an industry that most people like to stay largely under the radar. Not everyone in this industry likes doing podcasts like we do and broadcasting to thousands of people. A lot of people like to stay really quite quiet and private. So when you go against the current, you really are stepping out from the mob, I suppose, and putting yourself out there going, look, you guys are nuts, you got it wrong. Hey guys, welcome to this week's Money and Investing Show. Bit of fun this week. We're going to look at the movie industry and how it's portrayed some of the characters in financial services. Plenty of lessons to take out of this. A little bit more of a light-hearted view, but nonetheless some very, very serious lessons too. As always, make sure you take plenty of notes, but more importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olarenshaw.
Good to be here, Mr. B. Now, I'm very excited for today's episode. We're going to have a bit of fun with today. We're going to talk about Investing 101, but importantly, lessons from movie characters. Very, very insightful, some of the personalities we're about to explore too, let me tell you.
Oh, wow, that's a bit of a different scope on it. Hopefully a bit more lighthearted and yeah, some big lessons to take away.
Art imitating life. It's one of the best ways to learn. And if we can learn from the mistakes, but also the successes of some of the most successful movie characters out there. And I think what better way to start than with our good friend, Mr. Jordan Belfort from The Wolf of Wall Street.
Yeah, perfect place to start. I mean, look, where do we even start with that? I mean,
I don't know.
I know Jordan pretty well. We've spent a lot of time hanging out. We've done a lot of events together over the years. And I would go so far as to say, without question, he'd be one of the smartest people I think I've met in my lifetime. And where it all went right, where it all went wrong, I think in his case, where it went wrong, and he'd probably say the same thing, is that he being as smart as he was, he could have taken two paths, legitimate or not legitimate pathway. And I think in his early business career, he definitely opted for the not legitimate pathway and was highly successful at it until it stopped and imploded. And if you look at his second coming, I suppose, will be the term, within his sales training, it's immense and it's excellent and just shows the depth of skill that he had. He just, I think, would have probably preferred to have just taken the right path the first time. Indeed.
Now, that character was played by Leo DiCaprio. And for anyone who hasn't seen the movie, Belfort style, great movie.
Well, and again, I reckon DiCaprio absolutely nailed him in that movie. Did. So I spent plenty of time with Jordan and absolutely nailed his personality to the nth degree. And I think, there are a lot of threads to take out of that. I think the short-term gaming of it, where, making money very, very quickly, which was a priority for Jordan, I think, at that time, and not taking a legitimate pathway was the mistake. But the business model and the detail and the finessing in it and the training of scale. And that's the biggest challenge, I think, for people in business, is that if you have a particular skill set and you set up a company to do something, that's great. Then you hire someone to help you, and then you hire more people to help you. The initial skill set or expertise that you have is quite hard to scale. And I think that's one thing that Jordan did particularly well, albeit for the wrong reasons, in Stratton Oakmont, is scale his sales prowess across an army of people.
Indeed.
That were far from a force for good, but yeah.
So for our listeners out there, Jordan Belfort, that business model was they'd pitch rich investors blue chip stocks, get them in, and then they would start to pitch the pump and dump, which were speculative stocks that they'd drive the price up.
Yeah, they'd buy a massive stake in a company that had no real value, get a analyst report doctored up that said, oh, this is a great stock, get their sales team on the phone to call people and say, this is a brilliant stock, bearing in mind they already own massive, massive quantities of it, drive the price up, and effectively at those high prices would be selling stock that they bought for 2-3 cents. and be selling it for $5 or $6.
The pump and dump.
Unwitting public, supported by a doctored up analyst document. So, yeah, highly illegal, and all came crumbling down.
Now, the lesson for investors out there is there are many illegal things you can do in the stock market, notably insider trading, front-running prices, high-pressure sales tactics if you're in that business.
Yep.
What do we take out of it as retail investors, AB?
Look, I think you've got to be very minded that there's a process for engaging with financial services. You need to have in Australia a company that's got a financial services license. In all fairness to Jordan's business, Stratton Oakmont, in the US, it was also licensed and regulated too. And I think you've got to look at the processes that are going on and make sure that you understand the nature of the investment that you're in, as opposed to being told what it is. And I think that really, as an organisation for us, has driven us very, very deep in that education pathway. So we have clients that are educated, that understand what they're doing, why they're doing it, how they're doing it, so that they can actually make more informed decisions, as opposed to being railroaded into a decision by a very, very highly trained salesperson. That says, sound fair enough.
Yes, indeed. Sounds very fair enough. And also, too, don't get addicted to drugs and alcohol, because that can really mess up your life. I think that's a pretty obvious one.
Yeah, I think you could probably apply that outside of financial services too, but certainly added immense colour. And I mean, as a movie, it's a long movie. It doesn't feel like it's long. It is a very entertaining movie, albeit the subject matter is, it looks like it's party and fun on one side, but obviously there's a loser on the other side of the ledger, which are the thousands of people that were ripped off.
Indeed. Well, let's shift gears now. Let's look at Jeremy Irons. So recent movie Margin Call, maybe 10 or 12 years old. Kevin Spacey's in that show.
Yep.
When we talk about that movie, what springs to mind first and foremost?
So Margin Call, that was a movie that came out on the back of the GFC. And the interesting thing with all movies around finance is not that interesting. So you've got to find a spin or a hook that makes it appealing to people. And Margin Call came out, not too long after the GFC as the sort of wreckage hit the ground. And it was largely orientated around what were called mortgage-backed securities, which in essence was the cause of the GFC. And the particular investment bank that Irons was running was the biggest market in that particular product, and they had an analyst that sort of hit pay dirt and said, this is just all junk. These securities that we're selling for millions and millions of dollars are effectively worthless.
Breaching the VAR, the value at risk.
Yeah, and because as a bank you can gear up, you've got to keep a certain amount of Tier 1 capital in play, unless it's a mortgage-backed security, which is a little bit different. They were geared up to as much as you possibly could and beyond on these kinds of securities. And so, and again, there's a light and dark side on it. Irons comes in and said, right, we've discovered this problem. Nobody else knows about it. Let's get rid of it. And the team, the risk team, are saying, look, if you do that, you're going to kill the market. Who are you going to sell it to? And I think his response was fairly candid, and it was the same people we've been selling it to for years. The argument or retort back was, well, we won't have any relationships left if we do that. He said they won't exist tomorrow anyway if this thing goes down the way it looks to be. And it was really quite hard hitting. And, the GFC, is quite a decent flesh wound for many investors today. I mean, we saw a very sharp sell-off in markets, that 30-40% sell-off, and it took markets quite some time to recover. I think the Aussie market took nearly 12 years, for example, to get back. But what I would take out of that movie in particular, and it was actually very, very well put together based on my experience of working in that environment, was Jeremy Irons. It's sort of 3 o'clock in the morning, and they've got an emergency sort of team meeting
in on the chopper, by the way.
And what are we going to do with this? And what he said, and I think this is actually quite profound and quite true. There are 3 ways to make money in this business. You can cheat, which is not what we do, and you can be smart. Everyone's pretty smart, or you can be first. And in that instance, their notion was, well, if there's going to be a problem, we may as well be the first. So we're going to dump all this stuff on the street. There's going to be carnage. Our reputation's gone, but all our competitors will be bust. So we'll survive, which is our primary concern here. And it's a pretty hard-hitting movie, and they got the job done and obviously did survive, but really good movie. And
I guess if we look at this from an element of trading psychology, so you talk about that 3 a.m. board meeting, things could have easily gone very wrong with craziness and the chaos that could have ensued. However, they were very measured in their approach, which I think actually saved them as they peeled back their decision-making layers and made the right one.
I think you have to be totally objective, and as soon as, and I'm sure we'll explore some examples of this in a minute, but as soon as that red mist comes down and your decision making becomes far more emotive as opposed to practical, then that's genuinely where the wheels come off. So it was a pretty calculated, I know it's a movie, but it was a very, very calculated and cold decision based on logic, and we'll deal with the consequences of that logic tomorrow.
Now, for retail investors out there listening to this, how that applies to them, margin calls, that's a real thing if you're using borrowed funds, right?
Correct. So if you've geared your account up, and that could be through things like a contract for difference, or if you're trading margin FX, when the trade's profitable, it's great because there's quite a substantial return versus the amount of cash you've put down. However, when the pendulum swings the other way and you're into a loss, you could make $100 loss on a $20 deposit, in which case you've lost 5 times your initial stake. So what a margin call effectively is you have to put more money in if you want to keep the position open, or you've got to get rid of the positional part of it to maintain the balance in your account. And I've always been of the view, I'm not a fan of margin trading under any circumstance, and I'll never have been from a retail investor. I've done plenty of it personally, and I've done plenty of it professionally. But for retail traders and investors, I don't think it's a good thing, because you do run the risk of losing money that's not yours, or that you don't own, or more than what you put in. Neither of those are particularly good outcomes for the retail investing public. And so things like margin lending, I've never been a fan of. CFDs have always been very sketchy on, and I mean, I've done a ton of futures trading, which is probably at the pointy end of margin type trading. Where I think there's a slight exception, and this taps into, I think, our expertise in the options market, is that if you're going to use borrowed funds, then you also want to use insurance to protect the position, so you can find yourself in a situation where you never have an outstanding debt when the trade winds up. If it goes horribly wrong and the asset you bought becomes worthless, you've got insurance to pay the loan back, so you're not having to find that money. And I think from an efficacy perspective, that's a really important market to have in the sand, to say that we just don't engage in unprotected margin type business, because the consequences for retail clients are really dire, and they very seldom, even if they've ticked that they understand, would very seldom really understand genuinely the pitfalls of what can go wrong when it does go wrong. And trust me, when it goes wrong quickly, and it's typically very savage when it does. So yeah, you can use margin trading if you've bought protection. That would be my hard and fast rule for retail investors. Nice.
Great lesson there, AB. Now, in similar tone, switching gear. So Christian Bale, my personal favorite actor of all time, played Michael Burry in The Big Short. Margot Robbie made an appearance in that, a few other notable actors as well. Now, that was
Let me know how you spend your time.
I watch finance movies and I work in finance. It's only to realize my job's never as exciting as the movies, but there you go. So Michael Burry in The Big Short, he predicted the whole thing in effect and then managed to profit from it.
Yep.
Now, what lessons can we take out of that?
Well, I think one of the hardest things within markets are very much a herd mindset. If you talk about analyst expectations, for example, there's always consensus, which is the big mob or blob that sits in the middle, and then there's a little bit of peripheral action around that. But most people like that central tendency of being part of the mob. There's a security factor there. And when you choose to step out from that spot, there's enormous pressure, because you're putting yourself out there in an industry that most people like to stay largely under the radar. Not everyone in this industry likes doing podcasts like we do and broadcasting to thousands of people. A lot of people like to stay really quite quiet and private. So when you go against the current, you really are stepping out from the mob, I suppose, and putting yourself out there going, look, you guys are nuts, you got it wrong. And given the fact that you're dealing with, in most instances, some pretty smart people, not always, but in most instances, some pretty smart people that are part of that blob, you've really got to have some confidence in yourself to go, look, with all due respect, I know you've got your PhD from MIT or Oxford or Harvard or Cambridge or wherever it might be in financial modeling, but you're just wrong. It takes an awful lot of courage to do that. But just because everyone's doing something doesn't make it right. And probably one of the better examples of that, if you go back to the days of Enron, and that actually is a terrific movie too. It's more of a documentary, The Smartest Men in the Room. And it's a really good insight into Jeff Skilling and how his ego drove that business, and Kenneth Lay, worth watching for sure. Wall Street were big buyers, just like they are in NVIDIA. And there's no comparison with NVIDIA and Enron. Let's be very, very clear on that. But just like everyone is got on the gravy train for NVIDIA right now, everyone was on the gravy train for Enron when it was going through its stratospheric growth phase. Except for a couple of analysts that said these numbers are just rubbish. They are so not right. They're not being treated correctly from an accounting perspective. And it's all smoke and mirrors, and it's going to come crumbling down against a share price that was on a stratospheric trajectory up. And by being an analyst in a bank that comes out and says, we don't think your stock is worth anything, I think you're fabricating your books, which to all intents and purposes the analyst was, your ability to get corporate deal flow or to do any acquisitions or anything for Enron is gone. So you're missing out on tens of millions of dollars of potential remuneration for the firm in doing that. So you're under massive pressure. As it happened, that person was right. And Enron was smoke and mirrors, and there was no substance to it, and the accounts were all over the place in terms of the way that they were, booking profit for stuff that they're booking profit on a power station that hadn't even been built based on what its projected earnings would be. So, that analyst in that case was right. And in the case of Michael Burry, he was right. It was a very, very overdone market, and he spotted something within there and had the means to take his own position against that. I think the challenge for retail investors, particularly, and I guess that's our audience to whom we're speaking now, is that you're going to run out of cash or liquidity to fight the market. Unless you're an institutional investor and you've got access to billions of dollars of funds, you can't fight what's going on in the market. And if you take the opposite side of it and it keeps going up, that's where you're going to get a margin call and it's all going to go wrong. But he was right with his analysis and got rewarded handsomely for something that not everybody could see. And here's a really interesting quote, I suppose. Everybody looks, but only some people see. Everyone wants to look at the market and see what's going on, and there are a handful of people who actually see what's going on, the inner machinations of it, and he certainly picked it and made his dough. And that's, Enron is a good example of that too, in terms of other analysts that have sort of been out of step with the market and been right.
Indeed. Go against the grain if you have to and do your research, be detailed, right?
Can you imagine the pressure you'd be under? You'd be getting ritually humiliated by the industry going, who's this clown? What would they know? Why are they so out of step? Etc. And then obviously when it's time to do your lap of honor, everyone hates you because you've made a killing.
That's right. Now, last but not least, how could we forget? Gentleman we've actually had on the podcast that we've spoken to is Nick Leeson.
Yeah, good old Nick. Yeah, Nick's an interesting character, Nick. And so Nick Leeson, the movie, Ewan McGregor, I think, played him in Rogue Trader. And this was a series of events in the late 80s, early 90s, which was early 90s when I started my career. And that was very, very good insofar as it reflected a huge deregulation in the City of London. There was something that came along under Margaret Thatcher, who was the Prime Minister at the time, called the Big Bang. It was a real deregulation of financial markets where the broking and trading industry went from being filled with people from Eton and Harrow and the top private schools in the UK and Oxford, Cambridge graduate type thing, through to a new type of city employee, which were very much not the normal character, people that had, in some instances, less qualifications, most certainly weren't from the right background, etc. And that expansion that went on was really quite phenomenal. And London became, and to an extent is still, the hub of global trading from a currency perspective based on time. And also with the life floor, which I'm very familiar, the futures side of things. So Nick somehow got a job in the back office with Barings Bank, which would at the time was the Queen's Bank. It was one of the oldest banks in the UK, very, very traditional firm, very staid, very conservative. If you didn't have a hyphenated surname, you probably shouldn't be working there, kind of thing. and fixed up some problems in the back office. His maths pretty good. Fixed up some problems they had in the Middle East in the back office, and their reward for him was to say, okay, look, you've done a good job here on this accounting and admin side. What would you like? Here's a reward for it. And he managed to parlay himself into an opportunity on the trading floor, which I can relate to. And I don't necessarily think he was probably that good as a trader or indeed at following orders and protocol. So with very minimal training, they sent him over to Singapore to set up the bank's Far East trading division. And very quickly, he started to have a few problems and challenges in terms of some losses.
How would you classify his investing style, just for some context? Cavalier,
out of control. Out of control, totally unsanctioned.
Loose.
And no place for that. But it did happen. And so he had some errors on his book. And you know how we treat errors within the business. It's very clearly disclosed, the procedures for managing it, and you've got to go through it. What he did was, I don't want to get in trouble, he was new setting it up. So he kind of parked them across into what became known as the 5/8 account, parked the losses in there. And because of his experience in the back office and settlements, he was able to just mask those losses for a period of time. And it wasn't a big loss, maybe it's $1 million. And then did the unthinkable and actually traded out of that error to clear it out. And
successfully for the first time, right?
Successfully, yeah. And so it's like...
Got away with murder.
Got away with it. Never doing that again. Learnt my lesson. And where Bearings had gone wrong is that not only was he head of their trading, but he was also in charge of all the settlements and the back office as well. So you basically had the gamekeeper and poacher being one and the same person. Now, to give you an idea, under normal circumstances, back in the UK, our valuations were signed off twice a day, once in the morning, once in the afternoon on the value of the account. You couldn't get into the back office. It didn't matter who you were. If you're from trading, investing, investment management, trading floor, there was a locked door which you didn't have a pass to get in. No one would let you in. So you can't go in there and say, oh, don't worry about that trade, don't book it. Or, yeah, I'm just trying to switch out of that. It's a mismatch or whatever it might be, or crossing, whatever you want to put on it. You had no ability to interfere with that. That's how it's done when it's done correctly. So it's church and state. You're over there, you're making the decisions. We're over here counting the beans. You get no say in what we show. You just have to sign it off. And if it's not right, that then triggers an immediate stop on your trading. You got a mistake. We're saying the valuation's that. You're saying it's that. Let's go work out what the difference is. Okay, yeah, it's just a misbooking. It was on the wrong account number. All square, carry on trading. But it was twice a day. There was that fuse box in there to prevent you from then doing what Nick suddenly went on to do. So he cleared his loss the first time round and then made some more mistakes, and then it just got totally out of control.
We're talking billions, right?
Yeah. So two things that were going on. I think one is the level of stress. And when you're stressed, it's like red brain. You don't make good objective decisions. And I've spoken to him at length about this. And so he had a long exposure to the Japanese Nikkei. And the reason he had that exposure, he wasn't allowed to hold exposure on the bank's account. They were just simply there trading for a client. So if you're the customer, I'll buy your order for you. It gets booked to your account. He was booking trades to the bank's account, which was strictly forbidden. And not just a couple of trades. We're talking literally tens of thousands of futures contracts on the Nikkei. So you're banking on the Nikkei going up. And then to try and hedge the risk, which is unfathomable, that you shouldn't even have that position in the first instance, let alone of that scale. To try and hedge out, he had a bullish position on Japanese government bonds. Now, you've done economics and you understand that equities and bonds actually correlated. So instead of hedging out, he's just amplified his overall exposure.
He's doubled down, in effect.
And so when it all went wrong, there was an earthquake in Kobe, which the backside fell out of the Nikkei on the back of it, as you'd expect, level of uncertainty. Markets dropped a ton, bond markets dropped a ton. So not only is his position gone crazy, but also his hedge has done the exact opposite and exacerbated the position. All up about £1 billion, which back then was a really, really large sum of money, and ended up bankrupting the bank. So, I mean, it's a great story, and Nick is actually a very, very charismatic person. I think he makes a great career now in the speaking space as an after-dinner speaker, and actually focuses on risk management. And I did nail him down when we did the podcast, and if you haven't listened to it, go back.
It's a great listen, by the way, for our listeners.
It was a couple of years ago now.
Be a year, yeah, I reckon 2021 maybe.
And I said, like, the key takeaway, number one, what would it be? He said, you have to have a stop loss, which he obviously never had. Your first cut's the cheapest. And he ignored his own advice because he was so in deep and not making logical decisions. And I think number two is that you have to make a decision based on your process, not based on your emotional reaction to what's actually going on. And that's really hard. I mean, if you see a decent sell-off in markets, and you saw COVID firsthand, when you see a red screen that's just dropping like a stone, and if that's the value of your money dropping like a stone, you can start to really get inside your head as to what you could and should do. So you've got to try and maintain that objectivity. You have a trading plan. And then the discipline to really follow it. Nick didn't have a trading plan. He didn't follow his compliance plan. What he's doing was illegal. He went to jail for it. And then in the red mist stress moment, managed to balls it up totally by then doubling down by not having an appropriate hedge as well. So yeah, shocker, absolute shocker. But bloody great guy to have a chat with.
It's just amazing listening to this, that this even happened.
And he was able to hoodwink, the bank, and the compliance team there for probably about 18 months by just covering it up with various explanations. And that time, if I go back to the early 90s in particular, derivatives trading was a new thing, and investment banks were just working out just how much money you could make out of the futures market or the broader derivatives market. And so the compliance regime and understanding of how to book trades and what the implication was, instead of what it looks like on face value, what's the liability that goes with it too. So instead of, there's a bit of profit there, there's also this liability that's equally as menacing sitting in the background. There wasn't a genuine understanding of that at the time. Now, of course, it's much different. And to an extent, I suppose you could argue that the same is true of crypto, where you've got something that people see the opportunity with, but the legislation and the compliance and the oversight hasn't quite caught up with the pace of the instrument. So, yeah, there's a good example of history repeating itself maybe in a slightly different way. But yeah, Rogue Trader, Nick Leeson, great movie. The best line in the movie, he's talking to his mate when he finally confesses that, look, I'm doing the wrong thing here. And he said, well, how big is your position? And he says, big enough to be a problem. And he's trying to close out of it. And the broker on the other end of the phone is like, yeah, how many contracts do you want to do? He said, just keep selling them. He said, but how will I know when the order's filled? He said, you won't ever fill it. Just keep selling.
Yeah.
And stark reminder that A, don't break the law. B, have a business plan. C, have a compliance checklist. D, don't have a poacher and gamekeeper role in the same business. And E, make sure people are trained and educated as to what they're doing. Don't just let them loose and hope they can work it out.
Indeed. Well, let's hope Netflix is not barging in our office in 2 years' time, maybe filming us for these, right?
I reckon we'd be pretty good. I reckon we'd have some good war stories, to be honest.
I reckon we would too.
It'd be pretty dull.
I've been saying this for 4 years about a Netflix doco on us.
Yeah, I think maybe I'm getting older, Mitch, but I reckon it just should be predictably boring. That's how I like to run my business.
Like Seinfeld, just a show about nothing.
It could be a show about nothing, but bottom line is simple. It's about process, and if you sort of look at, and I guess Hollywood does a great job of glamorizing, and there's got to be a hook and an excitement. And across two of the examples we use, they're people I know personally, and they're pretty accurate in terms of what was captured for the sake of the movie. But there's always a lesson to learn in that too. And if you watch a movie and come out of it and go like, that was a great movie, you also think, okay, what can I take out of that too? And plenty to take out. Don't break the law. And two of those are very good examples. At least two of them, at least, are good examples of breaking the law. One is just don't get swept up by the herd. You've got to be a free thinker. And probably the other one is be first.
Very good advice, AB. Thank you very much. That was a really fun episode.
Glad you enjoyed it. What are you watching tonight?
Probably one of those. Maybe Wolf of Wall Street for the 700th time.
Fair enough too. Don't be throwing any midgets around this office tonight.
Thanks, AB.
Good on you. Cheers. There you have it, guys. Make sure you give us a review and a rating, and we'll look forward to hosting you next week.